Venture capital investment process. In venture capital investment deals, there is a lot at stake. It's a multi-million-dollar bet that the venture capitalists take. So it is natural for the entire process to be a long one. Let's look at the process in detail. Deal origination. The process begins with venture capital firms searching for potential investment opportunities. They need a constant flow of new ideas to consider. These ideas can come from different sources like recommendations from other companies, business partners, industry groups, and even personal connections. They also actively look for opportunities at events like trade fairs, conferences, and even in international markets. Sometimes, there are middlemen who help connect investors and entrepreneurs, and they can be helpful in finding potential deals. Screening. Investors start by quickly looking at different projects to see which ones are promising. They check various things like the technology or the product being offered, how big the market is, how much money is needed, where the business is located, and at what stage it is in terms of development. In some places, like India, they might ask for a brief overview from entrepreneurs to see if the project matches with their criteria. If things look interesting, they arrange a meeting to learn more. Evaluation. Once a project clears the initial review, it goes through a detailed examination. This involves carefully studying the project, the potential market, the technology being used, and estimating how much money it could make. Investors also look at the people behind the project, their skills, honesty, and experience. They even think about the risks involved. All of this helps them to decide how much risk they are willing to take for the potential reward. Deal negotiation. If the project looks really good, the investors and entrepreneurs talk about the terms of the deal. This is like setting the rules for their partnership. They decide things like how much money the investors will put in, what they will get in return, like a part of the company, and what happens if the company grows or gets sold. The deal has to be fair for both sides and protect everyone's interests. Post-investment activity. Once the deal is done and the project gets the money it needs, the investors become more like partners. They help the company to succeed by giving advice, sharing their experience, and sometimes even joining the company's board of directors. But they usually do not interfere with everyday operations unless there's a big problem. Exit plan. Investors don't want to stay in the company forever. They eventually want to make a profit. So they plan how and when they leave the partnership. This could be in the following ways: by selling their part of the company through an initial public offering or IPO, through the sale of their shares to another company at the time of acquisition, by selling their part back to the original owners. So that's how a successful venture capital investment works. In the next chapter, we look at how exactly a venture capitalist looks to exit the company they invest in.